stocks looking a little unreliable here this morning. We're flip-flopping, but holding in there. Let's go to a place that's been very reliable, and that, of course, is the wonderful world of Walmart. Joining us, Arun, Sundaram, equity research analyst at CFRA. Tom's here ready to do some trading. You know, when markets start getting swingy and volatile, Arun, it seems like Walmart just keeps finding its groove.
Yeah, Oliver. Yeah, thanks for having me. Yeah, I mean, Walmart has been, one of our top performers for the last few years now, and it's gaining market share. It's growing margins. It's growing earnings as well. Like even the last quarter, comparable sales for Walmart in the U.S. is growing about 4%, which is really strong in this environment. And importantly, that growth is being driven by traffic. So a lot of incremental traffic, especially amongst higher income consumers who are now increasingly shopping at Walmart. And it's also helping, grow their online business. And Walmart's e-commerce business is growing really rapidly. And with the growth of e-commerce comes the growth of new revenue streams like advertising. They sell advertising on their website, which is a much higher revenue stream. And so we're pretty optimistic that we'll continue to see strong sales growth as well as margin expansion over the next few years for Walmart.
Is there anything that gets in the way of them? Maybe a Kroger-Albertsons tie-up, takes the grocery market, or is Walmart locked in?
I mean, Walmart's been taking market share away from conventional grocers for many years now, even going back to before the pandemic. We don't think that's going to change anytime soon. Even looking at the upcoming quarter, for example, for Kroger, we're expecting a little bit less than 1% same-store sales growth. Again, Walmart, the last quarter, they posted about a 4% comp growth, meaning they're taking share there. And for grocers, they really need to grow comparable sales, at least in the low single-digit range, like usually around 3%. In order to expand their margins. If they don't, if they only grow 1% or even see sales decline, that can really hurt margins because there's a lot of fixed costs that go into grocery, and that's what we're seeing right now with Kroger, because they're not able to grow comparable sales to the same rate as other players in the space. Their margins are also hurting, and so that's why we're not expecting much earnings growth for Kroger this year. Versus for Walmart, for example, we're forecasting about 12% EPS growth for Walmart this year.
That's a big difference, right? What about the potential for the deal? Seems like the government doesn't really want this to happen for Kroger and Albertsons.
Yeah, so right now we see a 20% chance that this deal closes. Ultimately, we think this judge, who is a judge that was appointed by President Biden, will ultimately rule that this is an anti-competitive deal. The FTC is really attacking this case from multiple angles. Their strongest case is the market overlap concern. There's going to be a more concentrated market if Kroger and Albertsons merge. Now, what's up for debate right now is the definition of the market. The FTC is trying to take the old school definition, which is just including conventional supermarkets, which means Kroger, who's number one, is merging with Albertsons, which is number two. Versus Kroger and Albertsons, they're trying to push for a more forward-looking definition of the market, which would include companies like Walmart, Costco, Amazon. But unfortunately, in the past, historical precedent has signaled that typically the old school definition is what the court will use. So that's what they're fighting in court right now, and the FTC is also attacking this case from other angles as well. They're also arguing that the divestiture partner that Kroger and Albertsons is using, C&S Wholesalers, they're actually predominantly a grocery distributor. They don't have a large grocery retail business. And so the FTC is arguing that they don't have the necessary experience to run these divested stores. And then ultimately there's a chance that these divested stores could fail. And then lastly, the FTC is also saying that this merger could harm workers. I think this is probably a weaker argument in our view, but again, it shows that the FTC is really taking a belt and suspenders approach to trying to attack this deal.
CNS, right? If they want to take it on, why not let them take it on? Isn't that kind of what it? Again, we don't the merits of capitalism, but they're willing to take it on. It's not like they're putting it on them, right? They're buying it from them.
Well, so one of the arguments is that the reason CNS is taking it on is because they're getting a really sweet deal for this. There's been internal documents citing that about 2/3 of the sale price of this deal is just the real estate value of these divested stores.
Wow, okay.
So that could signal, hey, maybe down in the future.
Okay, I guess maybe if they're just pricing it as pure real estate, then yeah, okay, maybe basically. Hey, real quick on Walmart, Arun, what's the surprise? Do they have any, as good as and reliable as it is? What about potential for surprise for investors? Does that is dividend, buyback extension, or is there anything that kind of adds any juice onto the trade at all, or is it just more kind of staple grinded out?
Well, I mean, I think when I talk to clients about Walmart now, it trades at a really lofty multiple. It trades almost like a tech stock these days. But the company is growing almost like a tech stock these days. And I think what investors are really excited about with Walmart is that they're growing beyond just core retail. Like I said, they're growing their advertising business. They're growing their third-party fulfillment business. They're growing their online marketplace. They're growing their health and wellness business as well. And these are much higher margin businesses. At the same time, they're investing in things like automation, things like that. And so I think really right now, investors are really optimistic about the long-term margin expansion opportunities at Walmart, where, a decade ago, we were not talking about, operating margin expansion at Walmart. It was Walmart's historical operating margins have historically been around 3 to 4%. But now we're thinking, in the next few years, it can get to 5% and may potentially even reach 6%.
Wow.
Which for a company that produces $500 billion in revenues per year, that's a lot of extra profit.
Nice, yeah. All right, well, I guess that's why the chart looks the way it does, up and to the right. Thanks, Arun. Good stuff. Like the details there, fun little diversion into the grocery world for a sec. Let's come back into the market here today for a moment. As the Nasdaq's down about 90 bips right now, tech having some trouble. I guess more reason to trade Walmart, Tom, because we need something stable and reliable right now.
Yeah, I think investors have been cheering this one all year, up over 45% so far. So it's had a great run, just below all-time highs. But those valuations are starting to grow. The comments from the CEO on the last earnings were pretty spectacular, with the fact that, hey, in any economic environment, whether it's high inflation, low inflation, it's going well, it's not going well, they perform. And I think that's key. So I looked at a strategy with it near all-time highs. Does it kind of putter out, or you want to take something neutral? If you want to own the shares, you can collect that 1% dividend. So I looked at a covered call strategy that has a little bit of upside, but then it gives you opportunities to roll and adjust your short strike on this strategy. So for every 100 shares of stock you buy in Walmart, I went out to the October monthly cycle, so 42 days to expiration, and just sold basically an at-the-money call, the 77.5 strike call. You're paying roughly about a 75-40 debit for this covered call strategy. So you're buying the shares in this strategy. You're getting them at about a 2.2% discount to where it's currently trading, just below 77.5. You get to collect that dividend yield. You see the break even is what is the price that you pay. So this allows you to own the shares, collect that dividend yield, and then as you get closer to October expiration, you can roll or adjust that short call. So what this type of strategy does, it's longer term as far as duration goes, and it just allows you to keep collecting yield by selling calls against your long stock. So
beautiful.
It's conservative, but at the same time, you're still in the shares.
And you don't have to get them to, you create your own dividend.
Yeah.
You don't have to get them to pay out some extra, even
Right.
though it seems like Arun, with all the profitability they're going to have, believes they would be able to, increase that.
Right.
All right, I like to trade, so cover call, make a little extra money.
Yeah.
And park it in Walmart. Kroger next week, I mean, probably pretty volatile, I would think.
Yeah, you would think. The option market pricing in about a plus or minus $3.50 move in the share. So, typically we don't see massive moves in this stock. I believe he's got a neutral rating, about a $55 price target.
It's kind of wild, though, lately with the deal in the...
Yep, but are we going to get any confirmation or news on that besides earnings next week? So I looked at something short term, taking advantage of that higher implied volatility level in the near term options. So I looked at a double diagonal where I'm going to go out to the September monthly cycle, so expires on the 20th on these, 2 weeks to expiration. And I'm going to buy a strangle in there. And what that means, I'm going to buy an out-of-the-money put. I'm going to look at buying the 57 strike call and buy the 49 strike put. That's buying a strangle. And then in the near term, September 13th options that expire in 7 days, where you'll capture that earnings event, I'm going to sell the 53 strike call and the 53 strike put. So I'm selling a straddle in the near term September 13th options, and then making a risk define by buying that strangle in the September 20th options. Buying this double diagonal, you're collecting a credit of about $2.40 on this. So what that means is, you can see here from the risk profile, it means that I'm selling at near-term volatility, and my break-evens on this one between just below $50 a share and just above $56 a share on this. And as you get closer to expiration after the earnings event, I can roll that short straddle on the 53 strike short call and put to the September 20th options, and that'll collect a credit also. So it's a neutral type strategy. You want it to hover between those two break evens going into it. But the key is you're collecting that big, massive credit on it due to the fact that you have that volatility dispersion between what you're buying in the September 20th options and what you're selling in the near-term September 13th option. So gives you an opportunity to roll and adjust it and collect more credit. That'll expand your profitability on it, but it's definitely a neutral strategy.
Okay, it seems like a nice approach. I like it. Good use of volatility.
Yeah.
And collecting a little premium in Walmart too. Thanks, Tom, for the trades here in a group that is offering a little safety. Walmart staples.